Well, the greatest amount of wealth in real estate is created from appreciation. That's just the fact of it. The interim cash flows are exciting, but if real estate was just about cash flows, there's other risk-adjusted returns that can get great cash flows, especially now. You can buy tax-free municipal bonds. You can get dividend-yielding stocks that actually have liquidity. So if you're going to go ahead and take the risk to trade liquidity for returns, you need to be factoring in what that growth is going to be. So the growth factor is what makes real estate extremely interesting. Yes, we can get into some jargon about being hedges against inflation, but ultimately an inflation hedge is meaning appreciation. So if it's taking, $20 to buy the same the same commodity that was $10, effectively that change from 10 to 20 is where the growth is. So we can't exactly time when that is going to happen. We can have a high degree of certainty that it is by investing in certain markets, certain asset classes that have population growth and this, that, or the other. So you need to create a buffer to be able to do that. I think market timing is for the birds. I think it's actually, more akin to gambling. So in order to say, to really set yourself up psychologically, because I find talking to our clients that are public pension funds, insurance companies, trustees, athletes, celebrities, doctors, you name it, we've run the gambit. I feel like our job is to, really be a psychiatrist in a lot of these instances, over the years of how things actually come. With that said, setting the stage, I think at the very least, you should be thinking 5 years, okay? And I say that from really a psychological commitment standpoint. So if you go into one of these products saying, look, and our job is to underpromise and overdeliver. We make our money, when we sell these assets as well. So we're in the same boat in terms of when you make money, we make money. What I mean by that is, have we had deals that we sell out in under 5 years? Absolutely, a huge portion of them. Actually, the vast majority in terms of quantities of deals we've done have sold under 5 years. But that doesn't mean that we're not psychologically prepared for it to be 5, 6, 7 years, okay? So in your mind, when you make these investments, be able to say to yourself, could it be sooner? Great, but I'm prepared for it to take at least 5 years. And I find that to be, after studying thousands and thousands of deals throughout my career, that is really the mark. But I will also say, in the best of markets, the longer the hold periods, also the higher returns. So for us, we are selling within that 5 to 7 year period, or targeting, I should say. The lawyer in me is saying to be prepared during that, that fund life, so to speak, or deal life. But the largest returns have also been longer. So for us, it's really about opportunity cost of saying, okay, well, I sold this deal and we made a multiple on equity. We made whatever, returns we made. Great. So let's have something else that we can then go and be able to prepare to invest in to get into the next 5 year cycle. So I think that's making a long story longer. I think that the 5 year mark, but looking at our audited track record of exiting 60, 70 buildings in 38 cities and 13 states, it's been less than that, but I think we should be prepared for it to be that 5 year mark.